imperative when you are investing to continuously protect your capital. What that means is investing, a big part of investing, especially on the stock market, is emotional, because the same cortex in your human mind and human brain that works with things like gambling is the same cortex that works with investing on the stock market. Now, when you invest some money into a company stock and that company starts rising, a lot of times you don't sell the stock at the time you're supposed to sell because you want more profit. Hello everybody, welcome back to the channel. Gustav B Achu here. It's always a great plumping pleasure having you tune back to the channel. It's a great privilege for me. I appreciate that because it helps support the channel. If it's your first time on the channel, please go ahead and click the subscription button. While you are at it, also click the notification bell so that every time I publish a new video, you'll be the first one to receive that video. If you stay with me on this video for the next couple of minutes, I'll be able to share with you the 7 lessons I learned while losing $100,000 trying to invest on the stock market over the last few years, especially during the bull run of the last couple of years. Now, I will also be able to share some information with you that will be vital, especially because where we are right now, we are almost at the end of the bad times, the recession. A lot of economists are suggesting that by the middle of next year, we'll start seeing things change significantly for the better. What usually happens during that time is that everything starts increasing in value, and it seems all of a sudden like everyone is good at investing, which is not the fact. So if you stick with me on this video, I'm going to share with you the 7 lessons I learned. And these are not lessons I read. These are things that happened to me, and it led me into losing over $100,000 on the stock market. And I'm sure as you're listening to me, you don't want to certainly find yourself in that same predicament in the next few months. But before I even progress, it's important to understand what a bull market is, because that's the word I'm going to be using. A bull market actually is a period during which the stock market, which is typically represented by the S&P 500, gains 20% or more over its last low in the long term, over the last lowest period. So basically, the S&P 500 was founded in 1957, and the average bull market based on the last 60 years happens every 5 years, and the S&P 500 averages about 169% in returns to investors over those 5 years of the bull run. So it's important to understand this. Why? Because when the bull run period starts, that's when things start looking up. That's when value is being created on the stock market, and everybody believes at that time that they could invest in different stocks, in different vehicles that they don't even understand, and make money. And I'm one of those who fell into that trap. That is why today I want to spend this video talking to you about the 7 lessons that I learned. The first thing I learned while losing $100,000 during the last bull market on the stock exchange is, number 1, investing is not a game of monopoly. You see, for most families, the way most of us were taught about money is we play the game of monopoly. Most families, most children, most people in my generation and the generation before and after me, most likely will play monopoly at some point. And in monopoly, you use virtual money. You buy virtual property. You invest in virtual assets, right? You gain money, you sell things for virtual money. And in that same process, you also lose money. But the difference between monopoly and the real life is that the money you lose in monopoly is fake money, but the money you lose on the stock market is real money. This is money that can impact your life. This is money that you worked and saved up, right? So you need to understand when you're trying to invest on the stock market, that is not a game of monopoly. This is serious business. This is stuff that people go to school and learn how to invest in the stock market. So the first lesson I learned after that hard process was the fact that, listen, Gustav, this is no game. You cannot just get up in the morning and you hear people talk about different stocks and you go ahead and you try to buy them and expect that they're going to grow and things like that, right? The second lesson I learned is invest money that you are willing to lose. You see, one of the mistakes a lot of people made, and I made a little bit of that too. Fortunately for me, I certainly had an emergency fund, but I took a little bit more risk than I needed to have taken. I invested a little bit more money than I should have invested, which I wasn't willing to lose. But in that period of time, because the market was doing a bull run, because there was value being created, and there was incremental appreciation in investments, it felt like everybody knew what they were saying, right? So during that period of time, of course, I went ahead and invested, including money that I wasn't willing to lose. And when the market started changing and the market started turning the other way, losses started coming in and I lost significant amounts of money. So the second important lesson to learn is the fact that you want to invest money on the stock market that you are willing to lose. The third lesson is a very interesting one, because when everything is said and done, I think this is the lesson which, if I knew way ahead of time, it should have guided everything else that I did. There is a difference between a trader and an investor. I want you to pay attention to this. There is a difference between a trader and an investor. A lot of people, especially during the bull market, including myself, used to think of myself as a trader. Meanwhile, I was an investor. A trader generally are people who hold positions, who hold stocks or different assets which are traded on the stock exchange for short periods of time. So they buy it, they hold it for a short period, and they resell it for profit. Sometimes they might resell it for loss to stop their loss or to minimize the damage that has on their financial purses, right? So because during that time it was a bull market, everything was appreciating. Even some of the stocks that really were not fundamentally sound, with companies that were productive or with companies that really had a track record of doing something significant, even though their value was appreciating, everyone felt like they were experts at investing, right? So during that time, we all got caught up. A lot of people got caught up, including myself, who were not really traders per se, who had good amount of idea about how to trade stocks, how to research some about stocks, how to research companies, but who were not really experts in trading. And we were trading thinking we were investors, right? Our goal was to invest. My goal was to invest money, but I found myself trading money, trading stock every day, trading positions every day, when I wasn't even in the best position to do that because I didn't have the expertise to trade on a daily basis. Sometimes I even tried my hand trading in things like options, in things like different vehicles, which I wasn't good at just because a friend of mine suggested to me that I should do that because he has expertise in option trading and he will give me an option call and I'll trade. What a mistake. That mistake is 100 and above thousand mistake for me. It cost me to lose a lot of money. So the number one thing you want to do if you're new to the game of trading or you're planning to get into investing, understand that a trader is different from an investor. A trader is somebody who takes maximum amounts of risk. They try to buy things in the short term and try to sell it back to make short-term arbitrage or make short-term money. But an investor should be somebody who is looking at the long term, who is looking at about 10 to 15 years and above in investing. And generally, why that system works, why that strategy of long-term investing always works, is because it's been proven over the 100+ years that the stock market is existing. That is a cycle. There will be a recession and there will be a period of expansion. There will be a period of a bear market and there will be a period of the bull market. But overall, when they accumulate those amounts, those different changes in the market, in the long term, those who are patient, those who have their investments quiet and they only continue to add on that investment, they only continue to dollar cost average on the different stocks for companies or ETFs they own, in the long term, they end up coming out successful because there will be appreciation over that period of time. So it's important to understand the difference between a trader and an investor. The fourth lesson I learned, and this has completely changed my investment style and my investment strategy, is the fact that simple and boring investments like index funds and ETFs will always be trending. You see, we live in a time today when everybody goes behind trends. 1 minute is luxury goods and that's the trend. The next minute is a new trend. The next few months is a new trend. Please beware, the stock market doesn't work like that. The stock market might have trends, of course, a time when some companies go up, go down, maybe because of some news of a change in the company's management, or maybe there have been approval if it's a drug company by the FDA of some new drug, and so naturally it creates euphoria and people will go ahead and start buying that stock, and because of the increase in demand, then the price of the stock will go up. But generally, the boring investments like index funds, like S&P 500 index funds, like ETF funds, right? And I'll have another video where I explain what index funds and ETFs are. But boring investments like ETFs, like S&P 500 index funds, these are investments that over a period of time, if you hold it and you continue to invest in that particular ETF or in those group of ETFs, you would come out very, very successful. Yes, you might not have sometimes the swing that the stock might have. For example, if you look at a stock like Amazon, if you bought Amazon 15 years ago, today you would have had appreciation in the thousands of percentage. But remember, in the middle of 15 years ago, you probably couldn't really tell if Amazon was going to be so successful. So it's a massive risk, even though the few people who've been successful with it speak out about it, how they made a great decision, but it's not like they had a magic ball. I don't think they had a magic crystal. I don't think they could really project the future. A part of it was a general risk, because there are many companies too, if you go back 15 years ago, they looked as good as Amazon at that time. They probably even had greater potential, but they never survived, right? So what investing in boring investments like ETF and index fund does is that it takes away that pressure and that risk. It mitigates your risk, right? It just gives you a simple bucket of stocks of different companies put together, which you can buy a piece of that bucket. And the advantage of that is if one company loses value, the other companies will increase in value, and it will keep that bucket alive and positive and in the direction of positive growth. So it's important to understand that simple and boring investments like index funds and ETFs are still trending and will always trend. The fifth lesson I learned in that period of time is that FOMO, they popularly call it FOMO, which is fear of missing out, FOMO. FOMO is your enemy. It's probably your number one enemy when you are in the investment game, when you're trying to build a nest egg, or you're trying to build an investment portfolio of stocks, especially on the stock market. Fear of missing out. One of the things that hit me so hard is sometimes my friends will call me at 4 a.m. in the morning. Hey Gustav, there is this hot stock, man. We are projecting that is going to rise by about 250%. Why? By the time you wake up in the morning, make sure you find a position and take on that stock. In fact, some of the trading platforms will even permit you to do aftermarket buying of stocks, which means you can place the order and it will be pending immediately the market open. The order activates automatically, right? I will wake up at 4:30 in the morning and I'll go ahead and take positions in those stocks. By the time I wake up in the morning, you know, by the middle of the day, you see the thing rises. Then by the end of the day, before you know it, boom, you've lost money. Yes, I could use stop loss and all those other mechanisms, but I'm just being simplistic here for anybody who is coming in new. I think this is going to help them, because I know all those things now. I didn't really understand how to manage all of this, especially with a full-time job, also focusing on work and trying to invest on the side. If you have a full-time job and you try to invest on the stock market, you will understand what I'm saying, right? I am trying here to be very genuine, to be transparent. I'm not trying to impress nobody. I'm not trying to dampen anybody's spirit of investing. Investing is a good way. The number one way to build wealth in America is through the stock market. But I want anybody who listens to this information, if this is helpful to you, it might save you some money. It might save you the stress. It might save you the emotional turmoil of experiencing the feeling of losing that kind of money over a short period of time on the stock market. Now, the sixth lesson I learned is it's imperative when you are investing to continuously protect your capital. What that means is investing, a big part of investing, especially on the stock market, It's emotional, because the same cortex in your human mind and human brain that works with things like gambling is the same cortex that works with investing on the stock market. Now, when you invest some money into a company stock and that company starts rising, a lot of times you don't sell the stock at the time you're supposed to sell because you want more profit. That greed gets at you. That greed keeps your mind only thinking only of the best case scenario and never thinks about the worst case scenario. So what happens is that you keep holding for it to increase in value. You keep holding, and by the time you know it, within a split few minutes, the stock has dropped and you've lost all the gains you were supposed to have on that stock, and probably in losses. Or maybe you are even lost the gains to the point where instead of $20 a share you would have gained, and you were waiting for it to get to a gain of $30, now you are down to $5 a share, right? So it's important to understand that you have to always protect your capital. So if you invest, let's take for example, you buy a company stock, shares of a company worth $1,000. Right? Even when the value of that company rises to $3,000, that is fine. That means you are $2,000 up. It basically means you are in profit of $2,000. But you can only get that profit if you sell that share. So what happens is, if you wait for that profit thinking it's going to increase even more, yes, sometimes it does. But instead of waiting for that, you want to sell it at the point of profit. Worst case scenario, you want to make sure that even if you lose some of the profit, but you don't lose your capital. You don't get into the point where the value of your particular purchase at that time is less than $1,000. Then you would have lost your capital. So at every point in time, when you are investing on the stock market, or if you're trying to trade sometime, because there's a percentage of your money you will always be tempted to use for trading. I mean, I have to be honest here, all right? We all are humans. I know the boring investments are good, but our natural human emotion always tempts us to want to trade a little bit and take a chance and see if maybe we could have a quick 200% gain here, or a quick 150% gain, or 10% or 20, whatever it is for you. That is fine. All I'm saying is that when you take that chance with a small, and make sure it's a small percentage of your money, if you don't understand how trading works very well, if you don't have a good mastery, don't take that unguided risk, right? When you invest the money, always keep an eye to try to protect your capital. Make sure you can lose profits, but don't lose capital. When you lose capital, that's when the reverse pain starts. That's when the damage starts, and it gets a little bit tough, because when you lose capital, you are trying to make up back for the capital you lost. You know what happens? Then you start taking even more risk, and when you start taking even more risk, you most likely will lose even more, and by the time you know it, you'll find yourself in the situation I find myself, having lost over $100,000. So that's the seed. The seventh lesson I learned: cutting your losses is critical to your survival. There are times when you're going to lose. As you know, in fact, studies indicate that more people lose more times than gain on the stock market. So let not the fluff really get into your mind and your head and you think it's always win-win. No, people lose a lot on the stock market, as I'm telling you. And so it's important to understand that cutting your losses is important, right? It's better to lose $200 than to lose $1,000. That is the mentality I'm talking about. So when you start losing, sometimes you have to make a decision to cut your loss. To say, okay, hey, Gustav, you know what? I will not recover from this loss. I will take a $300 loss and leave. I will take a 10% loss and leave. I will take a 20% loss, get out of the market and come back again to another play. That is very important, because when that happens, it gives you a chance to live to fight another day, right? So these are the 7 key lessons I learned on my way to losing over $100,000 on the stock market. I hope it has been helpful to you, and I hope it's going to help you really have it in perspective when you start investing, or if you invest already. But in the meantime, I want to encourage you to believe in yourself. I want to encourage you to continue to seek knowledge, to continue to seek understanding, to go ahead and read books and take seminars and train your minds. The economy in which we live today is an economy for people who are able to pivot, people who are able to learn new things, people who are able to reinvent and transform their lives. And on your journey to building wealth, on your journey to building a great financial future for you and your family, I want to encourage you to believe in yourself. No matter what anybody has talked upon your life, I don't know your upbringing. I have never met you and may never meet you in person, but I also understand that there are things in your upbringing that might have caused you to believe less of yourself. I want to encourage you that you are enough. Never stop being a blessing to somebody. And until next time, if you have any questions or any topics around personal finance or personal growth and motivation that you would like me to address, put it down in the comment and I'll look at it and I'll make a note and I'll prepare a video like this to that. Until next time, be well, be blessed, and never stop being a blessing to somebody. Bye for now.